Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast. We're going to talk today about the falling star. And what that means is, well, we alluded to this a little bit on the last podcast. We were talking about the Morningstar rating system. And so not only is Mark going to talk about it, but we have Chuck, who's the Senior Vice President of Global Research at Nepsis. We're going to dive in deeply on this falling star. And at the end of the podcast, we're going to give you a link that you can download a paper that talks all about this. So, Mark, let's get the conversation. And Chuck, welcome to the show.
Thank you, Matt. Great to be here, my friend.
Thanks, Matt. Always good to be with you.
All right, man. Well, this is where do we begin with the falling star? I mean, what is the issue? What is the major onus behind this being a focal point of today's podcast?
Yeah. Thanks for the introduction and the question. So, back in October 25th, to be exact, 2017, the Wall Street Journal published an article titled The Morningstar Mirage. And the gist of the article and the findings of that article discussed the whole star rating system that Morningstar uses. Of course, financial advisors out there rely heavily on star ratings, and more importantly, I think, individual investors rely on star ratings. I mean, I've talked to people in the past, I'm sure that, you have, Matt, Chuck has, where they've picked their 401k funds based on how many star ratings they had from Morningstar. People view that as the go-to and authority on the funds. And if it's got a 5-star rating, it must be a really, really good fund, right? That's common sense, right?
Oh, yeah.
Investors everywhere think a 5-star rating from Morningstar means a mutual fund be a top performer. Doesn't. And so what we're going to do today, I think, is, Chuck and I will opine. Chuck will give us some data points, some things that he found out as we have created we call them compasses here, Matt. These are short documents we put together that detail on these, and that's what we'll make available to people at the end. But Chuck, I'm going to, by the way, for people who don't know Chuck, Chuck's been working with me in my research area since 2006, 2005, 2006, and he heads up our investment committee, heads up our research team that we have here at Nepsis, and is responsible for putting out a lot of this research stuff that we put out. So always good to have Chuck with us on the show. Hey, Chuck, do you want to opine a little bit, talk a little bit about the falling star, give our listeners a little bit of meat to chew on?
I certainly can, Mark. Thanks for having me here and teeing me up. That was great. I would just, first of all, echo what you said. I think the key component, if anybody can take away from this podcast, is just this heavy reliance, if you will, by our entire industry. And you nailed it when you said financial advisors, right? Money managers, fund companies, investors, almost in this collaborative fashion, have made the Morningstar star system into something it was never meant to be. So maybe what I could do is just give some highlights as to just the specifics of it. So you said, again, you have these ratings that Morningstar gives to funds, 1 to 5, 5 being the best, 1 being the worst. Right. Certainly, it can be proven through this article and through other studies that investors treat stars as a guide to future performance. Now, that's the key. They almost, and I like to put it this way, that they look at a fund rating almost like they do when they go to a bank and they look at a certificate of deposit, always trying to find the one with the highest earning interest. Right. And this is the same thing here, right? Oh, if it's a 5-star, that means it's going to continue. We're going to talk about how that is a complete utter fallacy, and it has led to the detriment of investors over time and actually how they approach their own personal investing.
Yeah, it says, hey, Matt, you probably appreciate this. It says, Chuck says here that great work by the Wall Street Journal staff on this part of the research, as the data clearly shows that top-rated funds, on average, lose ground as far as their star ratings are concerned, while bottom-rated funds actually gain ground. So, for an example, this is a quote out of there, for funds that had an overall 5-star rating at any point. So people go and choose that 5-star rated fund. Wall Street Journal found that their average Morningstar rating for the following 5 years is 3 stars. In other words, halfway between the top and bottom. So, Nepsis, of course, we talk about Nepsis, Matt, right? Know what you own and why you own it. And I loved your example, and maybe you can share it with people about your friend over Memorial Day. But, this idea that investors don't know what they own and why they own it, they rely on other statistics to make their decisions for them. And the fact of the matter is that those statistics can be, not saying they are, they can be misleading. And a lot of it has to do with the fact that, the SEC and FINRA and all the legalese would tell you that you've got to put that disclosure that past performance is not indicative of future performance, right? And I think there's two key things here that investors don't think about. Number one is when they look at a rate of return on something, they have no idea how that rate of return was achieved. Absolutely. They have no idea how much risk was taken to get that return. And so therefore, why would you ever put your money into something if you didn't understand how the return and how much risk was taken in the beginning to get that rate of return in the first place? That's number one. The second thing that people don't think about is that when you invest in stocks, as Jeremy Siegel says, it's time in the stock, not timing a stock. Now, he actually says time in the market, not timing the market. But we've broken it down to say time in a stock, not timing a stock. Meaning, when you buy stocks, you are investing in a company, whether you know it or not, whether you're doing it in a mutual fund or an ETF. And when you invest in a company, we tell people you need to hold on to that investment as long as the fundamentals haven't changed for at least 5 years. You have to let the investment play out. But investors get emotional. They get sidetracked. They become concerned and worried, like your friend is, and they end up putting themselves in the emotional position. We've talked about don't be another Dalbar statistic, right? And they end up selling their investments at market lows and end up buying them back. I'll give you a great example. There's a stock out there. I won't mention the name of it. We own it for our clients. And this, by the way, we've been watching the stock for a while. Stock went from $44 to like $52 a share, right, in a very short period of time. And then the correction set in earlier this year. And the stock went from 52, 53, all the way back down to 44. We started buying it. That correction was in what, February or March? This is a long-term investment. But when I just looked before I came down here today, that stock was at 61.5. You see, the power of strategic cost averaging, we've talked a lot about in other podcasts, the power of knowing what you own and why you own it. You look at volatility as an opportunity. But when you take the star system into your foray, you are relying, in our opinion, in a gauge that is not necessarily going to tell you the whole story.
Okay, I need to pause you because I'm hooked on something that Chuck said earlier, which was the 5-star rating was not meant to be a performance indicator. So what was it supposed to be? The health of the company? I mean, what do these stars mean? I don't get it.
Well, maybe I can jump in there, Matt. It's a really good question. So it was meant to be an analysis of the fund, but only previously to the date that you're reviewing it. So again, it's not indicative of what the future is going to portend. So I'll give you a couple of things here, and just think about this. So Morningstar is rating these funds. They're rating it on the past, not the future. The beauty of this journal analysis, think about this, is that when a fund picked up its 5th star for the first time, right? So everyone should be throwing a party, right? All this money's going to come into the fund company. Think about this, that only half of them, those funds that earned their 5th star for the first time, held on to it for just 3 months before their performance in rating weakened. And it gets back to what Mark just said. You don't know how that performance was garnered within the fund that allowed it to get the 5-star rating. Maybe it took an inordinate amount of risk. Maybe it didn't. Maybe that was bellowed on a couple of holdings, etc. But the key thing here is that rating only held for 3 months before it began to weaken. That is fascinating to me.
Interesting, isn't it? But this is what investors use to make decisions and invest in. We've talked about this in the past, right? That there are two questions that I get asked more than any other question. Question number one is, of course, what's your historical returns?
Mm-hmm.
And of course, as you know, Matt, we don't publish returns and we won't.
Right. Because
historical returns are irrelevant. Well, then people will say to me, well, how do I know you do a good job or not if I don't know what your historical returns have been? And my easy response to that is, well, I've been doing this for over 20 years. We manage over $300 million. I'm going to go out on a limb and say that if I'm doing that, I probably do a pretty decent job. And they say, well, that's a good point. And then the second question they ask is about fees. What are your fees? Yeah. And, I always tell people, well, a fee is relative. We tell them what our fees are. We're middle of the road. Well, that's more expensive than I can buy in an ETF, in an index ETF. And I said, sure, but you're comparing apples to oranges. And so what they don't ask, what no one has ever asked me are questions like this. What percentage of your portfolio does your largest holding take? What kind of company? What is your largest holding?
Mm-hmm.
What percentage of your portfolio is in your top 10 holdings? What is your investment philosophy and strategy?
Mm-hmm.
What's your buy discipline? What's your sell discipline? Now, I was never smart enough, Matt, to go to school to be a rocket scientist, but what I just said is not rocket science.
Right.
It's common sense. I think the fee you're charged and the historical rate of return is far less important than the actual discipline, the process that is used to structure a portfolio and enable the investor to have an understanding of what they own and why they own it.
Now, I want to jump in here too, Chuck, and I don't know
Certainly.
which one of you is going to answer this question, but I've been doing this for a while, and in working with financial services professionals all over North America, it probably doesn't surprise you, Mark, but it might surprise you, Chuck, that I do ask those questions, and I ask a lot of the questions, and one of the biggest questions that I have asked has to do with their buy and sell discipline. And they immediately take that into, well, I'm not a tactical or I'm a buy and hold financial advisor. And I think this wraps all the way around to Morningstar because there's still those advisors are the ones who are latching on to the promotion of the funds that they own, right? That are based, hey, look, you have all 5 stars, right? So now I know that doesn't really mean anything, which really actually is blown my mind. I don't know if you can hear the steady hissing of all of the air being taken out of my brain, but I'm glad my mic's not picking that up. But so help me with that one. I mean, Chuck, since you're the senior vice president of global research, you do an enormous amount of research on this stuff. And Mark just said the apples to oranges sort of scenario or comparison. Help us understand this a little bit more, that how the buy and sell discipline is actually correlated to how other financial advisors talk about their investment, I'm air quoting, their investment management process, including Morningstar.
Well, certainly, and I'll just say this, and again, Mark has stated this on numerous occasions. My opinion is that to ask the questions like you just said about the strategy, how consistent is it, how deeply convicted is the manager, the lazy road is to simply rely on a star rating system. Also, number 2 is that our industry, I think, has actually programmed investors to rely on this type of information. We're going to get into this a little later, but think of how fund companies actually promote their products, right? It's how many stars it has, how many of its peer groups has it outperformed, and they don't talk about what the strategy is. So people are left to these devices that
or
they
the
believe.
risk.
Exactly, or the risk. Thank you.
No
Or the
idea how much risk was taken.
You got it. So they're left to these devices that they believe are programmatic and that are going to give them an answer, almost like putting something in, it spits it out, garbage in, garbage out, unfortunately. And Mark's point is well taken, and I would say that too as a research analyst. If we ever researching any money manager, I want to ask them those questions. Why do you buy what you buy? Why do you own what you own? When are you going to sell it? What fundamental factors are you looking at? And that's rare today, and it's highly unfortunate. It's part of the reason why we're having this podcast.
So let me take that a step further, Matt, on the buy and sell discipline. It's interesting. Obviously, we have a document that actually spells out our buy and sell discipline. And what I love, and I won't say the company's name, but when people come to us and they say philosophically, what do you believe? We believe that long-term investing is about investing in great businesses over time and continually investing in those businesses over time. It's the Warren Buffett school of thought. Some people have come back and said to me, well, everybody says they're a buy and hold person, but then they go and they sell a position, or they do this and they do that. And there's a big fund company out there that holds themselves out as a quote-unquote passive portfolio management. Well, what is the difference between active and passive? One is active, and one you do absolutely nothing. The only true passive investing is an index. Even people who call themselves passive managers where they're buy and hold, they still are going to lock profits in if their portfolio manager locking gains, raise cash for other opportunities. That's the fiduciary aspect of the investment process, right? And so when you look at buy discipline and sell discipline, you've got your criteria for the businesses that you want to own, which we use a lot of the Warren Buffett school of thought along with a lot of different metrics that we use that we don't go super deep into telling people because, frankly, we don't want to completely give away our money management to people to do it on their own. But the sell discipline becomes very easy, locking in some profits at the appropriate time to capture gains if the long-term fundamentals change, or you sell something, take a tax loss for tax loss harvesting, buy something stronger in the sector during corrections. At the end of the day, we invest in businesses over time. We've owned Visa and MasterCard, for example, since the day they went public. Now, that doesn't mean we haven't taken profit. We haven't taken some money off the table, gains, but we've owned them for a long time. And they're up, I don't know, one's up like 500 or 600%. The other one's up, I think MasterCard's up 700 or 800% since it went public. So at the end of the day, the definition, people have been brainwashed about passive versus active. That gets into what's the buy discipline, what's the sell discipline. And bluntly, Matt, none of it means anything if you don't have the ability to know what you own and why you own it. And oh, by the way, as you know, mutual funds and ETFs only report their holdings in the rears. Mm-hmm. In other words, it's reported the quarter after the quarter that's
absolutely
ended, which means that they may not necessarily hold that position today. And if you're a strategic investor, if you're someone who wants every advantage in your pocket to help you be successful, which I can't imagine there wouldn't be anyone who would, wouldn't you want to know at any given second, what exactly do I own, and what impact can that have on my portfolio? That has zilcho to do with a star rating, but that's the flaw, that's the opaqueness of the mutual fund and ETF business, hence the reason why Nepsis is here.
Now, hold on. We still haven't unpacked this whole, how did they get the stars? I mean, how do they even get them? Do they, if they're based off past performance? I'm sorry. This is one of my huge pet peeves when people talk about, they always talk about past performance. They do Monte Carlo simulations. They do all of these different things. Yeah. But then they have to say within the same breath, past performance is not, predictive of future results. Right. And so help me understand, help our audience understand, where do the stars come from? How do they get the stars? And let's at least put this falling star aspect to rest and get back to what's really important, which is investing with clarity.
Got it. Chuck, you want to handle it?
Certainly I do, Mark. Yeah, Matt, great question. So first of all, Morningstar has, and Mark used the word opaque, there's a proprietary modeling process that Morningstar uses to define between 1 and 5 stars. Think of the old bell curve that we used to have when we had tests that were graded in that manner by teachers or professors. So it's simply that it's a risk-adjusted return. So in essence, you could extract the formula, but it is not easily understood by investors and advisors. What they do need to know, I think, and this is the heart of your question, is does truly a 5-star rating lead to better performance or actually indicative of what that star that was granted to them is? And it isn't. I'm going to throw just a couple of stats at you here. Funds are more likely, once they get the 5-star rating, think about this, to turn into a 1-star performer than maintain that. Here's the hard cold stat in the journal's article. 86% of the funds with a 5-star rating perform less than that level. That means only 14 kept their 5-star ratings. You could actually make the case that's the worst thing to do, is to invest in a 5-star rating, right? Mm-hmm. So how does this occur? And Mark really laid it out here so nicely, is that, think about this. Brokerage firms are going to recommend high-star rated funds to a network of the 10,000 advisors, right, or whoever it is that's sifting through this. A broker advisor then turns putting their clients in that money. It almost becomes this CYA, if you will, covering yourself to say, okay, I put them in a 5-star fund now. It's not going to be my fault. And advisors get in trouble when they go against the grain. So this cycle continues onward. And the lack of clarity from all parties certainly is pertinent. And it puts this whole stars rating system into a massive question mark as to why do we even use it when actually the numbers support something radically different as a way that a person should be constructing portfolios.
Does that help, Matt?
Again, do you hear the hissing? Do you hear now? I don't think it's hissing. I think it's a slow smolder inside between my ears right now.
Well, listen to this. The Wall Street Journal found that investors put new money into 5-star rated funds in 69% of the months they held their ratings, compared with 29% for the 1-star funds. The Wall Street Journal, in their article, stated they found more than a dozen cases where well-performing funds attracted new investors until they won a 5th star. Again, you should not be making an investment. I guess the moral story is your investment decision should not be based on a star rating. It should be based upon knowing what you own and why you own it, and what's the potential impact of you accomplishing your long-term goals. And, of course, as we tell our investors over and over and over and over again, the most important aspect, Matt, of investing is the process.
Absolutely.
What is the investment process? How do you decide what you own and why you own it, and how much of it you're going to own in the total portfolio, and how does it impact the rest of the positions that are in the portfolio to achieve the goals that the investors want to achieve? This is why people ask about benchmarking. This is why people ask about fees. This is why people ask about, past performance. I always find it interesting. They ask about past performance, but past performance has to have the disclosure, like you said. It's not indicative of future performance, which in other words means tell me why past performance even matters, right? There's another stat. We did another white paper, Chuck, that this stat will blow our listeners away. The highest performing alpha managers. Now, when you talk to people about that, they don't even know what that means. Alpha really meaning statistically the risk taken to get the rate of return you got, that is actually more important in the short term on return as opposed to the historical returns, because many times returns can be garnered by taking on too much risk, so to speak, right? And so the study found that of the highest performing alpha managers, they underperform their stated benchmark almost 50% of the time. 50. We did a study going back 25 or 30 years on Warren Buffett, and of course the S&P is a legitimate benchmark for Warren Buffett. His stock from 1985 to 2008. Now there's 7. It's a little older, but we went back the last 10 years and numbers were still the same. He underperformed on a year-over-year basis. He underperformed the S&P 500 almost 33% of the time. So in other words, Warren Buffett has achieved the performance he's achieved by underperforming the S&P 500 almost 33% of the time. Now, if I came to you and said, we're a great money management firm, but we underperform the S&P 500 33% of the time, would you hire me?
Probably not.
Probably not. Yet here's one of the wealthiest guys in the world doing it. Isn't that ironic?
And known as one of the greatest investors of our time.
Bingo. The other question I want to ask you, maybe you can opine on this, Matt or Chuck. Who made the decision that we should gauge the performance of our portfolio on a calendar basis every year relative to a benchmark? I didn't realize the markets worked on a calendar basis.
That's a long-standing question I've asked myself, too, in the 30-plus years I've been in this business, and no one has ever given me a legitimate answer. It's wonderful, isn't it?
We need to get together at the end of the year and decide how my portfolio did versus the markets. Really, your companies, or do they base their investment decisions based on the calendar year?
No.
I mean, this gets back to the idea of story after story. We've talked about it here on the show. I actually did a radio show, Matt, where I went back and I dissected the charts of two very big companies. Netflix, which is now the largest media company, by the way, out there, and Apple. And over the course of time, I took Netflix from 2001 till now, and I gave the prices at certain points over a 1, 2, 3 year period. And over these periods, you could see, and this happened with Apple too. And Apple actually is notorious from going from a penny stock to $100 a share and all the way back to a penny stock before it came all the way back and became the size of the company it is now. This idea of people having short-term thinking, and when a stock goes down 50%, they should sell it. Well, in the case of Netflix and Apple, you can go back and look at historical charts, and you will notice over 1, 2, 3, even 5 year periods of time where the stock will go down 30, 40, 50% or perform flat over that period of time. But if you take the chart over time, over a 5, 10, 15, 20 year period, it has created an immense amount of wealth. It's time in a business, not timing a business. If the long-term fundamentals haven't changed, if they've gotten better on corrections, the theory would be you should be adding it to your portfolio. You can't have this kind of conversation with people who own mutual funds and ETFs. Everything is all tactical in nature. Everything is about quote-unquote program rebalancing, quarterly rebalancing. Whoop-de-stinking-do. What impact over time does that legitimately have on the overall performance? Because it still doesn't address the question of how am I getting the returns I'm getting. It doesn't.
Right. I have one final question for you guys.
Yes.
So let's take the Netflix example, right? So in those times that Netflix was down, was the trading volume up? Like, were there more people trying to buy it when it went down? Because I'm just thinking of like big companies like, Morgan Stanley's and, all of these huge juggernaut wirehouses that are out there, right? And they're making lots of money. Now, they're not obviously passing down all of that knowledge to the clients like you do to help them invest with clarity. But do you guys see that happening? Do you see when, because Mark, you're famous now for saying, well, because you're famous because I actually told a friend of mine, so that's how that works. But you're famous because, you talk about that volatility is an opportunity, right? It's not a crisis, yes. Right? And so I brought that up to my friend. And do you see that? I mean, Chuck, you're watching charts and graphs and stuff all day. Do you see when one of these primo stocks that you guys are talking about that are good companies that you should own, do you see their volume go up? Are there a lot of people running in to buy them as they're going down, or what?
Yeah, there's no doubt volume spikes.
Okay.
Now, we don't know who's buying it, right?
Okay.
But clearly, if wherever there is a buyer, there has to be a seller,
yes.
Right?
Yes. And
usually during periods of bad news, like quote unquote, we didn't hit our quarterly earnings numbers. The stock gets hit, right? I'll tell you, interestingly enough, in July of 2008, Netflix was trading at $3.98. Okay, that's in July of 2008. In May of 2002. It was trading at $1.21. In July of 2002, it was trading at 87 cents. So it went down to 87 cents in July. And you go to 2008 and you look at that $3.34. I'm not a rocket scientist, but even from $1 to $3.34, statistically, that's a big move over 6-7 years. Here's the thing. 10 years later, 2018, stocks at $351 a share.
Oh, my God. Jeez.
So, now you may sell some along the way, but, at the end of the day, owning great businesses has historically, no guarantees, of course, for disclosure purposes, has created great wealth. I mean, we did an analysis on Amazon, the same thing. Volume does go up because you have to understand, from our perspective, Matt, we believe that the majority of the retail investors out there are short-term thinkers.
Oh, yeah.
And the more you get into algorithmic trading, where you've got these robo deals going on, these algos that are producing, when to buy and when to sell to create their quote unquote alpha, they're looking at statistics within the quote unquote market. Well, that has zero to do with the long-term fundamentals of a business. And so you have to take the opportunity to buy those stocks when they go on sale. Because stocks may go down for different reasons. They may not go up for different reasons. And then all of a sudden, you wake up one day and holy cow, they just got bought. Or some big news comes out and the stock goes up 30, 40, 50%. You can't time this stuff. You got to. This is the whole Peter Lynch thing, right? Peter Lynch is invest in what you know, invest in what you buy, invest in what you like. That's why I always say, by the way, hey, Matt, do you have a Visa card? Thanks for supporting my investments.
Yeah, I have like 6 of them, but that's a different story entirely. All right. So if you don't mind, I'm going to tell the listeners the quick story that I told you, and then we'll go ahead and wrap up today's podcast. But Chuck, I would like to have you back because I want to talk about the discipline, right? We've touched on that a little bit, but I think it bears repeating for our listeners. I want to talk about how you guys make the decisions that you do, maybe a little bit, not secret sauce, and I understand that that's your proprietary information, but just give people a little look underneath the hood. We'll just crack the hook and take a look. So anyway, I was talking to a friend of mine who's very, very successful. He's a great guy. He's done very well for himself. And I just got off a podcast with Mark, and he had come over, and he was grumping about something, of course, because when you have that much money, you grump about things that most of us don't have to grump about. And one of them was that he didn't feel like he was doing that well really in the market. And I said, well, to tell me what you own. And he just kind of looked at me like really puzzled. And I'm just like, oh my God, are you kidding me? I mean, he's probably got $500,000 in mutual funds and ETFs, because that's what he told me. He said, well, yeah, I've got some mutual funds and some ETFs. I said, well, do you know what those are? And he's like, well, no, I don't have any idea. And I said, shouldn't you know what you're invested in? And so I went through this whole tirade for actually about 5 or 6 minutes, because I've heard Mark say this so often on the podcast that I became a commercial, for Nepsis and to invest with clarity. And when I got done, my friend looked at me and he goes, you're not even a financial advisor. I was like, I don't need to be a financial advisor. This just freaking makes sense. And he said, and so of course, then I told him to listen to your podcast. And so, for those of you who are listening who, one, have not subscribed yet, or two, aren't widely sharing this podcast with your friends and family, please do them the favor, because that is what you are doing. You are opening their minds to what investing should look like based off of sound evidence, sound philosophy, and really just common freaking sense. And that's one of the things that Mark said to me when I told him the story, is Mark was like, well, it just kind of makes sense, doesn't it? And investing with clarity, to me, does make an enormous amount of sense. All right, guys, any closing thoughts before I wrap it up today?
Yeah, the only thing I would add on that, first of all, thanks for the nice thoughts, comments. But the other thing I'd say is your friend said, he's not comfortable with investing in the market. We hear business owners say it all the time. Why would I ever invest in the stock market? I'd rather invest in my own business, because at least I know what I own and why I own it. Yeah. And one of the things I always tell investors is, I hate to tell you this, and I hate to burst your bubble, but you need to understand that technically you do not invest in the market. The market is where you go to buy and sell things. That's a market. And so you don't invest in the stock market. You invest in businesses. And so don't look at your investments as if you are investing in the stock market. You're not. You're investing in businesses. The stock market, as I always say, is nothing more than the greatest tool that has ever been created to bring buyers and sellers of businesses together.
We did a podcast on that.
Yes, we did.
We did a podcast talking about really what the market is. All right. Well, Chuck, hey, thank you very much for your brain. We always appreciate when you're on the show.
My pleasure, my friend.
And Mark, as always, thank you for your thought leadership too, and your desire, your strong desire to really truly educate the public on what a lot of us believe is really the right way to invest.
Thank you.
If you have not subscribed, what's that?
My pleasure.
Oh, good. Yeah. Well, it's an absolute pleasure talking to you all the time, too. I do appreciate this. And I was joking just in closing with my friend, and I think he used the word brainwash. He's like, is this guy brainwash you? I was like, look, dude, I've been podcasting with him for a long time. But when you talk to somebody who has so much passion, who has so much clarity, who has such a consistent message, guess what? that should really resonate with you. And if it hasn't yet, subscribe to the podcast so that way you can continue to learn more and more from everybody at Nepsis, especially Mark and Chuck. And for everybody at Nepsis, including Mark and Chuck, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.